What if I told you many of the most loved stocks in the market are not as strong as they look? While many everyday investors keep pouring money into their favorite so-called safe stocks, I am pulling billions out of positions once considered untouchable. I am doing it with deliberate action. My recent moves are not routine portfolio adjustments. They are a clear signal. I have reduced my Apple stake, once Berkshire's largest holding, by more than half. I have sold over $10 billion worth of Bank of America shares, walking away from a long trusted position. And most alarming for the entire market, I have raised Berkshire's cash reserves to a record $325 billion, the highest level in the company's history, both in size and as a share of total assets. When the greatest value investor of our time stops buying and starts stacking cash, it is not noise, it is a signal, and it suggests I see serious trouble ahead for the very stocks everyone else believes are safest. Now, you have to understand the scale of what we are talking about here, because these are not niche holdings or speculative bets sitting in the corner of portfolios. These are the core positions that define modern investing. Every single day, billions of dollars flow into index funds that are overwhelmingly concentrated in a handful of names. This is not diversification. This is the opposite of diversification disguised as prudent investing. Let me show you what I mean with some numbers. The so-called Magnificent Seven stocks, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and NVIDIA now represent roughly 32% of the S&P 500's total market capitalization as of late 2024. Think about that for a moment. 7 companies out of 500 account for nearly a third of the entire index. This concentration has no modern precedent except for one period, the Nifty 50 era of the early 1970s. Back then, institutional investors convinced themselves that 50 blue-chip stocks were so dominant, so inevitable, that they were one-decision stocks. You bought them and held forever. Companies like Polaroid, Xerox, Kodak, Avon, and Sears were trading at 60, 70, sometimes 90 times earnings because the conventional wisdom said their growth was unstoppable. Then the market repriced. Between 1973 and 1974, the Nifty 50 collapsed. Stocks that had been considered the safest holdings in America fell 80%, 90%, in some cases more than 95%, and many never recovered. The parallel is instructive, but there is a crucial difference this time. In the 1970s, most of that concentration existed in actively managed portfolios where fund managers made deliberate decisions to overweight those names. Today, the concentration is structural. It is baked into the indexes themselves through market cap weighting. Passive funds, which now control more than $15 trillion in assets according to Morningstar data, do not make active decisions. They mechanically buy whatever the index tells them to buy in proportion to market capitalization. That creates a feedback loop. As these 7 stocks rise, they become a larger percentage of the index. As they become a larger percentage, more money flows into them automatically. As more money flows in, their prices rise further, making them an even larger percentage. It is a self-reinforcing mechanism that has nothing to do with underlying business fundamentals and everything to do with the structure of modern portfolio construction. What I understand and what most retail investors do not is that this structure creates catastrophic fragility. When these stocks were smaller, when they represented 10% or 15% of the market, a repricing event would be painful but manageable. But at 32% concentration, a significant decline in these 7 names does not just hurt portfolios. It destabilizes the entire equity market. And when you look at the valuations these companies are trading at, that repricing is not a possibility. It is an inevitability. Apple trades at 30 times earnings despite revenue growth that has slowed to low single digits. Microsoft trades at 35 times earnings. Amazon, after its recent run-up, trades at over 40 times. These are not growth stock multiples. These are bubble-era multiples being applied to mature trillion-dollar enterprises. And yet the consensus view among retail investors and financial advisors is that these are the safest holdings you can own for the long term. That is the delusion I am rejecting, not the quality of these businesses. Apple makes excellent products. Microsoft has a strong competitive position. Amazon has transformed retail. But the prices, the assumption that these valuations can be sustained indefinitely requires believing that growth rates will remain high forever, that competitive advantages will never erode, that nothing will ever go wrong. That is not investing. That is faith. The concentration creates another problem that most investors have not considered. When something trades at these valuations and represents this much of the market, there is no natural buyer base to step in during a decline. If Apple falls 20%, who buys? Not me. I am already selling. Not sophisticated institutional investors. They are already at maximum exposure through index mandates. The only potential buyers are retail investors trying to catch a falling knife or algorithmic traders looking for short-term momentum. That is not a foundation for price stability. That is kindling for a cascade. It is important to understand how the market itself is reacting because those reactions reveal where the fault lines already are. Right now, retail traders are doing what they have been trained to do for 15 years, buy the dip. Every minor correction in 2024 and 2025 has triggered the same reflex. Social media, cheerleading, call option surges, and record inflows into the same index funds that already hold these over-concentrated stocks. Fear has been replaced by complacency. The average small investor believes every pullback is temporary and every correction is an opportunity. But when you look beneath that optimism, a more complicated story appears. Institutional data shows quiet hedging. The AAII sentiment survey hit 55% bullish at the end of August 2025, the highest reading since 2021, while professional money managers were simultaneously cutting gross exposure to equities. The CBOE put-call ratio has hovered near the lower bound of its long-term range, suggesting near total faith in upside continuation. Yet funding costs and volatility spreads, the hidden data most traders never notice, are flashing amber. Meanwhile, insider transactions tell their own story. Senior executives at major tech companies collectively sold over $9 billion worth of stock between March and October 2025, according to Form 4 filings. At Apple and Microsoft, insiders have been net sellers for 6 consecutive quarters. They are not quitting their jobs or shorting the market. They are watching the same valuations and quietly harvesting gains while the public celebrates new highs. It is not a conspiracy. It is pattern recognition. Now contrast that behavior with mine. While most of the market was chasing momentum, I was on the other side, reducing, then raising cash. Some analysts tried to paint this as old man conservatism, arguing I simply do not get the new environment. But look closely at my annual letter. I wrote that investors were playing with fire when optimism about price replaces understanding of value. That is not a joke or a throwaway line. It is a direct critique of how modern markets have become narratives trading against themselves. At the same time, the big institutions are publicly calm but privately nervous. Large asset managers talk about discipline, but their derivatives books tell another story. Futures data shows increased demand for downside protection at the very top of the market, meaning the pros are buying insurance even as they appear fully invested. Hedge fund net leverage has been dropping steadily since mid-2024 despite indexes climbing higher. In other words, the professionals are smiling for the cameras while fastening their seatbelts behind the scenes. I have been studying my investment philosophy for most of my professional life, and the longer you look, the simpler it becomes. Markets move in cycles. Investors forget that. I never do. I have spent 7 decades watching the same pattern repeat. Optimism, overconfidence, leverage, and then fear. The trigger changes, but the mechanism never does. So let us walk through the mechanism I see so clearly. At its core, every stock's price is a reflection of 2 forces, what the business earns and how much investors are willing to pay for those earnings. Multiply growth by confidence, and you get valuation. That sounds obvious until you realize how violently that relationship swings when confidence breaks. The earnings might still be good, but the willingness to pay those high multiples evaporates. That is what crushes markets. I have explained this dozens of times, often in passing, as if it were too simple to emphasize. Price is what you pay, I say. Value is what you get. In other words, the business is one thing, but the price you assign to it is another, entirely dependent on collective emotion. Right now, too many investors have blurred that line. They believe the multiple is the company's quality, that a great brand justifies any price. It does not. If you graph the S&P 500's price-to-earnings ratio over time, you can see the lesson repeated. From 2012 to 2019, the market averaged about 18 times trailing earnings. Today, it sits above 27. The Magnificent Seven sit between 30 and 50. That is not driven by earnings explosions. It is the market voting with optimism. But as I know, markets weigh over time. Eventually, euphoria meets math. Here is the mechanism in motion. Suppose you buy a stock at 35 times earnings on the assumption that profits will rise 20% annually. If growth slows to 5%, your earnings per share might still rise, but the market will no longer justify that 35 times multiple. If it falls to 20 times, a very modest reversion, you have just lost 43% of your capital, even though the company itself kept making money. That is not abstract. That is basic arithmetic wrapped in psychology. I have always said I would rather forego an opportunity than risk permanent capital loss. That is the discipline that separates me from almost everyone else. Most investors chase momentum because admitting the party has gone on too long feels like missing out. I simply leave the room early. The lesson I am signaling is not that America's great companies are weak. It is that even great companies become dangerous when price divorces from value. Popularity is not protection. In fact, in markets, popularity is often the final phase before reckoning. That is the invisible line we have crossed. Earnings have become the backdrop to a confidence game masquerading as investing. And when that game breaks, as it always does, people will not just lose money, they will lose faith in what made the system look stable in the first place. Let us look closely at the stocks that embody this danger. Start with Tesla. Its price-to-earnings ratio sits near 80 numbers, which imply decades of uninterrupted dominance in one of the most competitive industries on earth. Yet, global EV market share for Tesla slipped from 18% in 2022 to barely 13% by mid-2025 as Chinese automakers flooded the field. Margins, which once touched 29%, have compressed to the low teens. The cars still sell, but the multiple no longer matches the math. When growth slows even slightly, valuations at this altitude do not bend. They snap. Then there is NVIDIA, the new centerpiece of this bull cycle. The company earned roughly $27 billion over the past year, a number that would be staggering if not for the expectations embedded in its $1.3 trillion valuation. Wall Street's models assume data center revenue will double again in 24 months and that competitors will conveniently stay behind. But that is not how real industries work. When a single company captures such enormous margins, supply races and pricing falls, and the multiple collapses long before earnings do. Every cycle of excess plays out the same way. The crowd assumes the product is different this time. I assume the arithmetic is not. Apple, for its part, looks steadier but faces a quieter problem. Earnings peaked in 2022. Revenue growth has been flat ever since, and China's souring political climate threatens 1/4 of its manufacturing base. At 30 times earnings, investors are not just pricing in stability, they are pricing in impossible consistency. That is faith, not analysis. Faith in a brand, faith in endless buybacks, faith that consumer rotation will never happen. I built my career on opposing markets that mistake faith for valuation, and now I am voting with capital instead of commentary. To understand how this ends, step into the mind of an investor holding one of these names as the tide turns. Earnings miss. Stock drops 10% overnight. The instinct is to hold, convinced that volatility is temporary. The next week brings downgrades, algorithmic selling, margin calls, options expire against them. Smallholders panic sell to protect what is left. ETF redemption requests rise, forcing funds to liquidate more of exactly the same stocks. The loop feeds itself. What looks like a correction becomes a chain reaction. This is not about corporate quality. These are strong companies run by capable executives. It is about pricing psychology. When investors layer leverage on top of crowded trades, even stability turns fragile. I know the distinction between a 20% drawdown and a 70% collapse is not earnings, it is confidence. When confidence breaks, capital flees reflexively, seeking safety faster than algorithms can quote bids. You can already see glimpses of that fear in microform. On November 7, 2024, NVIDIA fell 3% intraday on no news, wiping out $40 billion in market value, roughly the GDP of Serbia, in 3 hours. That was not a reaction to fundamentals. It was a stress test of belief. Confidence cracked slightly, and the ground trembled far beyond the chart. Magnify that across a dozen trillion-dollar names, and you have the anatomy of contagion. Let us move from headlines to hard arithmetic, because behind every market panic, behind every confidence collapse, there is a pattern you can model. Imagine the market repricing we just described across 7 companies that together represent nearly a third of the S&P 500. The math becomes sobering very quickly. If Apple reverts from 30 times earnings to its 10-year average near 22, its stock falls roughly 27%. At current valuations, that single move alone erases about $900 billion in market value. Microsoft, trading near 35 times, would lose similar magnitude if its multiple compresses to 25. NVIDIA, far more extreme, could easily fall 50% or more if sentiment around AI spending softens even modestly. Combine them, and the top 10 United States stocks shed roughly $6 to $8 trillion in aggregate market capitalization. Now translate that abstract loss into lives. The average American household owns $250,000 in retirement assets, most of it indexed to United States equities. A mere 20% correction shaves about $50,000 off that account. For a 55-year-old nearing retirement, that is not a paper swing. It is a delayed retirement date. At a household level, that invisible wealth loss ripples outward through consumption, savings, and spending confidence. Economists call this the wealth effect. When investors feel richer, they spend more. When they feel poorer, even temporarily, they tighten budgets. In every major downturn since the 1950s, each dollar of lost market value has reduced consumption by roughly 3 to 5 cents over the following year. If $8 trillion in paper wealth evaporates, that is roughly $250 to $400 billion less consumer spending, comparable to erasing an entire year of United States auto sales. And the problem does not stop at consumer behavior. Once confidence erodes, institutions join the retrenchment. Pension funds reassess asset liability assumptions, forcing allocations out of equities into debt. Credit spreads widen. Corporate borrowing costs jump by 100 basis points or more, enough to turn expansion plans into canceled projects. Bond markets absorb that fear first, then equities relapse under the feedback loop of tightening liquidity. For years, I have emphasized that in markets, confidence functions like oxygen. You do not notice it while it is abundant, but when it is gone, it is all that matters. Imagine that oxygen suddenly thins, not vanished entirely, just reduced enough that breathing becomes labored. Investors start doubting their models, CFOs stop buybacks, analysts cut earnings estimates to be prudent. The mood shifts from exuberance to caution, then from caution to withdrawal. And here's why I look so cautious. I am not forecasting catastrophe. I am protecting against mechanical inevitabilities. Every generation believes it can cheat cycles through innovation or policy or data analytics, but risk, like gravity, asserts itself. Eventually, a 25% correction in overvalued megacaps is not an outlier. It is a reversion. The wealth effect that inflated for a decade in near zero rates will unwind proportionally faster under 5% yields. This is why I call cash a position, not an opinion. At $325 billion, Berkshire's war chest is not fear, it is preparation. When confidence collapses and multiples normalize, that cash becomes weaponized opportunity. For everyone else, it is oxygen deprivation. What feels like a steady market today can turn breathless almost overnight. Now walk through how individual investment decisions multiply into something systemic. Put yourself in the position of someone holding a portfolio built around these popular names. Your 401k is 60% equities, dominated by S&P and NASDAQ funds. For years, that allocation worked beautifully. Every dip reversed. Every correction felt temporary. Then one quarter, Apple reports revenue down 8% year over year. The stock falls 15% in 2 days. Your first instinct is to hold. You have been taught that panic selling locks in losses. But then Microsoft misses on cloud growth, down another 12%. NVIDIA's data center orders slow, down 18%. Within 3 weeks, your retirement account that showed $320,000 now reads $270,000. That is not volatility. That is a wound. So you hesitate. You stop contributing new money to equities, shifting future allocations to bonds or cash. It is rational self-preservation. But when millions make that same decision simultaneously, the entire machinery of capital formation stalls. Mutual funds experience net redemptions for the first time in years. To meet those withdrawal requests, fund managers must sell holdings, often the very stocks that are already falling because they are the most liquid. Selling begets more selling. The same logic plays out in corporate boardrooms. Stock-based compensation, which represents a significant portion of executive pay at tech companies, suddenly loses value. Key engineers and product managers who were equity-rich on paper now face underwater options. Retention becomes a problem. Talent starts exploring offers elsewhere. Morale deteriorates, not because the business failed, but because the stock price collapsed faster than anyone modeled. And when management teams see their equity shrink, they respond predictably. They cut discretionary spending. R&D budgets get trimmed. Hiring freezes take effect. Share buyback programs, which had been propping up stock prices mechanically for years, get suspended to preserve cash. Each of these decisions is individually prudent, but collectively they confirm the market's new pessimism. Earnings estimates fall further, stocks drop more, the cycle tightens. Meanwhile, the real economy begins feeling the ripple. Wealthy households, which account for a disproportionate share of discretionary spending, pull back. Luxury goods, travel, dining, all contract as the wealth effect reverses. Small businesses that depend on affluent customers see revenues soften. They lay off workers. Unemployment ticks up 0.5%, then a full percent. Consumer confidence surveys plummet. What started as a stock market correction morphs into an economic slowdown that was not driven by recession but by repricing. This is not the first time euphoria has disguised fragility. In the early 1970s, the Nifty 50 were treated as invincible, America's industrial crown jewels that could do no wrong. Investors said the same things they say now. These are not just good companies, they are exceptional. Buy them and never sell. Then came the repricing. Between 1973 and 1974, Xerox fell 71%, Avon 86%, and Polaroid 91%. Not because they stopped making money, but because valuations stopped making sense. Sound familiar? The dot-com era told the same story in digital form. Cisco, Intel, Microsoft, the technological backbone of a new economy, reached price-to-earnings ratios that broke the upper limit of sanity. In 2000, Cisco was priced for 50 years of uninterrupted compounding. When sentiment snapped, the stock collapsed 89%, even as profits tripled across the decade. A generation later, its valuation still has not recovered. The company survived, but investor faith did not. These parallels are not historical trivia. They are operating instructions. I lived through them. I remember how even the best firms become dangerous investments at the wrong price. In 1999, I was mocked on CNBC for missing the internet boom, accused of being out of touch. The NASDAQ doubled that year. Then it fell 78% in 2. Over the long run, staying disciplined made Berkshire's chronic underperformance in the bubble years irrelevant. The same math applies today. Look at the numbers. In 2024, the combined top 10 United States stocks traded at an average forward P over E ratio of 33. The 25-year average before 2020, closer to 18. Analysts justify the spread with words like AI revolution and cloud scalability. Replace those phrases with microcomputers and digital cameras, and you are back in 1999. The labels change, the behavior does not. My decision to raise cash is a judgment on that repeating pattern. It is not just that prices are high, it is that faith has replaced analysis. I am protecting against the one scenario most investors will not model. A long stagnation where prices flatline for a decade while businesses grind forward slowly. That is what happens when valuations unwind through time rather than collapse in days. It is quieter, but it destroys more wealth. And the data agrees. In the year following the tech bubble's peak, Household equity ownership in the United States dropped from 53% to 41%. Risk appetite did not just vanish, it stayed dormant until 2006. If a similar reversion played out from today's record household exposure of 61%, roughly $9 trillion would exit the market in rotation towards safer assets. That is not panic. That is repricing by attrition. So where does this leave the ordinary investor? Understanding history is not the same as timing it. Nobody knows when the vote of confidence turns into the weighing of reality. It could be months or years. But the message is clear through Warren Buffett's actions. The weighing always comes eventually, and when it does, the longer the illusion has lasted, the heavier the adjustment must be. He is not betting on collapse. He is betting on arithmetic, and arithmetic always wins. If this insight resonates with you, stay informed, subscribe, and be ready for what comes next.